So this video is going to be highlighting a worrisome trend that I am seeing in the indexes right now. Now feel free to completely disagree with me in the comments down below. I'll be reading all of them and responding, but I've been investing for over 7 years now, and I've seen lots of market trends come and go, and my honest opinion is right now there's another one happening with the major indexes. So sit down, get comfortable, and hopefully I open your eyes to something happening in the market. And of course, if you enjoy, leave the video a like, subscribe, all that kind of stuff. But let's get into this. Okay, so the first issue is that the S&P 500 over the past 1 year is up almost 30%. That should be a red flag to everybody. Because you have to remember, when you buy into an asset, you're not buying its previous performance. You're investing in its future. And it seems to me that a lot of people piling into indexes right now are doing so based off of the assumption that the future price performance is going to be something like this. But I have to say, this is extremely unlikely, and I'm going to show you data to prove it in a second. To me, this is super reminiscent of what happened with the ARK Innovation ETF back in 2020. People piled into this ETF and just the general stay-at-home technology stocks because they were going up, and they had the expectation that they would continue to go up. In fact, this chart shows the data to back that up, because this is the price of the ARK Innovation ETF against the fund inflows and outflows. And the clear human behavior here is that as the price goes up and it becomes more expensive, that's when people buy into it. And don't think for a second that all because these are indexes that they're immune to these problems. But that in and of itself isn't evidence that the indexes are overvalued. To understand this part, now we need to understand how stock price is determined. And here there's two major components. The first is the earnings of the actual underlying equities, and that's represented by this green line. Now earnings do fluctuate up and down, but over time earnings tend to grow. Now the valuations are the second component here, and there's usually a multiple applied to the earnings that dictate its value. And in comparison to the earnings of an actual company, the valuation people place on it is way more volatile. And it's heavily affected by investor sentiment, the news, and macroeconomic events. But generally, the idea is that over long periods of time, they do move in the same direction. Okay, so that begs the question, how are the valuations right now? Because that's the single best tool we have to predict the future of these indexes. And unfortunately, it doesn't look so good. So this dotted line here is where the valuation of the S&P 500 should be, using the historical average multiple placed on earnings of 20. And this line is the actual valuation, or the price of the S&P 500 in relation. And there are times that it dips below and the multiple comes down, and there's other times like right now where the multiple and the valuation is just extremely above the average. The last time the indexes were trading at such a high valuation was back in the dot-com bubble. So that's bad enough, but the situation actually gets worse because the Federal Reserve is changing their monetary policy. So starting in 2022 and moving well into the future, the Fed is going to be stopping the money printer, raising interest rates, and eventually selling assets and actually taking money out of the economy. And this directly affects the multiple people are willing to place on stocks, because in a situation where money is very plentiful, people give higher valuations to companies. But when the Fed changes policy and money is not as liquid as it once was, valuations come down. And that's why we have articles like this. Wall Street bets the S&P 500 will say goodbye to outsized gains in 2022, citing that the Fed's expected interest rate increases in the year ahead could make stock investors less willing to accept lofty valuations. We also have people like Morgan Stanley saying that by the end of 2022, their prediction is an S&P 500 at 4,400, which is lower than it is right now. And I just want to sound the alarm on the situation because I see people making the same mistake as with the ARK Innovation ETF. They're buying in at all-time highs simply because the past performance was so good, and they have the expectation that it's going to continue into the future. Now here's some more insights on the situation, and I'll leave this website link down below if you guys want to check it out. So the price growth of the S&P 500, especially in recent years, outpaces the growth in earnings, and that's represented by this right here, which is the historical P/E ratio of the S&P 500, and currently it's very high. In fact, this might be a better view because this is the cyclically adjusted price-earnings ratio. This is the historical average, and we can see right now we're pretty expensive. In fact, we're were 96% above the average, which is more than 2 standard deviations, and again, the only other time it's comparable is the dot-com bubble. And finally, this is the graph I showed you guys in the beginning of this video, and this kind of puts it all together. So this dotted line here is where the valuation of the S&P 500 should be, using the historical average multiple placed on earnings of 20. So this indicates that the 1980s was a phenomenal time to buy stocks at a discount valuation. Same thing during the '08 recession. But according to this, right now stocks are extremely expensive compared to their historical average PE. So all those factors combined indicate to me that this scenario right here is extremely unlikely to happen. I think something like this is way more realistic, giving you better buying opportunities. And it just saddens me to see people like this making the same mistake again. They bought into tech stocks in 2020, thinking the valuations would continue to go up, and they're doing the same thing now but with the indexes. But of course, this is all just my opinion, so let me know in the comments down below what you think. If you're still watching and enjoyed, definitely give the video a like, subscribe to the channel, helps me out a lot and I greatly appreciate it. But regardless, I'll see you guys in the next one.